So first of all, thank you all very, very much for joining this session. It has been our observation, let's say, over the last few weeks to months that the whole topic of funds and AMCs becomes more and more relevant for the market. So the idea is to go through a session whereby we describe how AMCs and fund can basically work together, right? So it's not about them competing necessarily, at least as structures, but more about how they can complement basically each other for the benefit of the investors and the asset manager, right? So as a very quick agenda point, we will start as usual with a quick overview, an intro of Gen2 and an overview of how things have been evolving in the last few months. Then we have a small touch point, let's say, on the private assets market evolution. I think most people are actually aware of how strong the trend has been over the last few years. Then we will talk about the actual Gen2 solution virtually, right? So what we propose, what is possible, how it works, what are the benefits, and so on. And then we will have some selected deals, so real products that we have structured with AMCs and funds to demonstrate basically some of the most popular use cases. And we will close the session with a Q&A. So two important points. First of all, the webinar will be recorded. So it will be published, I would say, by latest tomorrow with the slides that are going to be used. So it will be available for people to watch it again or share. And second, the Q&A session at the end, as per usual case. So we will use the Q&A function of the platform, right? So that people can type their questions, and I'll be very, very happy to answer them. Having said that, we will go through quickly the Gen2 USP, basically. So for the people that is the first time that come across our offering, Gen2 is a Zurich-based company, about 5.5 years old. Our mantra is that we're able to expand the investment universe across asset classes. So we create structured notes that have an ISIN, cleared by SIX, Euroclear, and so on. And inside the underlyings can be anything from, let's say, simple equities and bonds to private assets, funds, private equity, private debt, real estate, art, and even digital assets, right? So we basically expand the investment universe, both for the benefit of the managers. We're able to deploy in the market more investment strategies across asset classes, and of course for the investors as well. And that's actually a very big focus in this session, right? Now, we divide the market in three different groups, right? So we have the private markets, as anybody can understand, instruments or underlyings that are not quoted, are not purchasable via an exchange or a broker. Public markets, the bread and butter of asset management, and the digital markets. Now, the breakdown of our business between the three categories at the moment is approximately 50-52% the public markets, right? Close are the private markets, about 40-45%, which is actually quite impressive. And we have the remaining on the digital markets, which of course is very volatile depending on the current valuation of Bitcoin and the likes, right? Now, with regards to the company itself, I believe it's always very interesting to show some numbers, right? How it has been evolving. So, as I mentioned, the company is about 5.5 years old. We recently bridged through $3.1 billion across all the products. So it's a pretty nice hockey stick evolution of the assets. We have actually more than 300 clients and partners at the moment, and a couple of other 100 counterparties which are involved in different roles around the product. We have about 1.2 thousand investment products launched already across asset classes. And then on the right, you see that AMCs are basically dominating in terms of payoffs with almost 70%, which is not surprised, right, based on their flexibility and so on and so on. And also we as I mentioned before, it's very balanced. And on the private side, one product on private markets doesn't necessarily mean one underlying, but it could be multiple private markets underlyings. So speaking about private market underlyings, here we see geographically what we have done so far. Here we basically see that in almost, let's say the most common markets, the most popular markets, we have already successfully launched products on private equity, private debt, and funds, right? And this is also, it's on the upper right. You see a small apex with the explanation of the different colors. Now, with regard to the private markets themselves, so I believe we all know that over the last at least 2 years, I would say, the markets have turned a lot into private equity, private debt, and usually wrapped into funds, right? Here we're using some data from McKinsey, actually, right? So I believe this will be quite representative. Of course, as we all know, it's not possible for somebody to have the exact number of these deals because there are a lot of private transactions and so on. But nevertheless, here we see that basically over the last 10 years, the outstanding notional of the exposure in private markets has more or less tripled. And I think that stands true also based on our conversations with the different asset managers and banks. Now, I was actually last week in London in the Financial Times Wealth Management Forum, and this was a very, very big and popular topic for discussion, right? So the private markets, how they should function, basically, how the liquidity constraints affect the different investor classes, how should or could even retail investors have access to that, how should it be managed, how should it be governed, and so on, and also what kind of trends one sees in the market. So one other very interesting point that we indeed see more and more, also I would say in conjunction with the recent, not so recent anymore, rise of the interest rates, is the fact that the financing that even countries or companies or SMEs or even private persons need, the expectation is that over the next 10 years, it will be mostly market financed versus the classic financing routes that somebody would expect from banks or central banks and so on. So that itself means that, to make things simple, somebody that has a company or works for a company and would like to raise financing to increase the business and so on, instead of actually going to the bank or having, let's say, a more traditional way of financing it through bond issues and so on, they could do that with, it could be a fund or it could be a structured note or basically a market instrument that people can buy and invest, right? The direct investments into physical assets, also a very big trend, probably also because, I believe we are aware that last year, the traditional equities / fixed income 60-foot portfolio had its worst year since, several decades. So I believe people are looking into that more and more. And finally, a component that should not be overlooked is that with private markets, the complexity tends to be higher than with the public markets, right? Because of public markets, you normally invest in equities via an exchange or instruments which are extremely standardized. Whereas in private markets, normally there are agreements, there are offering memorandums, there are prospectuses, and so on and so on. So that is also something that is a key, let's say, focus here in Gen 2, that we keep complexity as low as possible, at least for the side of the investor who ultimately would like to have access, would like to have the instrument booked in a simple way, and would like to participate to the performance, right? Having said that, our solution, the Gen 2 solution, is in a very, let's say, broad overview, a way to provide the possibility to asset managers to pool investor capital and deploy it in the best way possible. So in this slide, I will attempt to make a very quick overview. So what we see is basically the representation of our setup per client, client being the manager of a strategy or a wealth management or a family office or a bank, right? Not the investor. So that's an important distinction. Top to bottom, what we see is the dedicated issue, right? So because of the mantra is that we provide complete segregation of assets per client and per strategy. So It all starts from us establishing basically in Guernsey a segregated SPV, and that SPV would be used as an issuer for the issuance of multiple strategies. So this issuer is an orphan standalone SPV. That means that this is off balance sheet and cannot be consolidated, meaning in contrast with the normal structured notes issued by banks and so on, that in our case, the client and his investors are not exposed to our credit risk, right? Because it's standalone SPV. And then below here, we see examples of 3 different strategies, right? The first one on the left is an AMC hedge fund. Then we have a tracker on private equity fund and a tracker on a real estate fund. So not only the SPV itself is segregated, but each one of the products is basically issued out of its own protected cell, meaning that there is no cross-contamination between the different strategies. So it's kind of like a dual segregation / safety layer for the investor. The way it works is that for each strategy, we have a cell which is assigned to an ISIN. Normally, we use 6 SIS as a clearing agent at the Swiss exchange virtually, which can also be cleared via Euroclear and so on. So standard note, each product will have its own term sheet, which is produced by us. So basically, our structuring team, legal team, and so on will analyze the specifics of the deal. That could be a fund subscription or a fund memorandum, or it could be a share purchase agreement, and so on. And then from that, we will create a term sheet, which is, of course, a modular document, and it's the legally binding document of the investment. Following that, as you see here on the bottom, basically the investors are able to, with this document, go to the banks and make a subscription to the note. So we can say that ultimately for the investor, the underlyings of the note or the specific strategy doesn't change anything in the way they would buy the product, right? The product would still be a structured note, cleared by 6, having an ISIN, potentially quoting in Bloomberg or listed, etc. So as a quick recap, it's a bankruptcy remote issuance of multiple products. All the products are completely segregated in their protected cells. It's a white label solution. So our client would have his own issuer virtually so that he can create products and Gen 2 and so on. We will not have to be mentioned, right? You could use your own brand, colors, marketing material, and so on. We can have virtually any type of asset securitized into the notes and offered to the investors. It can be, as I mentioned before, anything from a fund or a liquid strategy to art, card collection. Usually it's quite popular recently, and so on. And actually, you can even combine. So in theory, you could say that I would like to create a tailor-made strategy whereby 40, 50, 60% of the assets will be liquid, for example, equities, listed equities, and the remaining will have a private form, such as a fund or a direct investment, right? And finally, a very important point, I believe, is that unlike the fund world, let's say, that people are used to the closes and so on, here a note normally has just the primary market and then the secondary after issuance. And that means that somebody could continuously throughout the lifetime of the product receive additional subscriptions. So that means that, for example, if you have a note, let's say on hedge funds, right, and the performance is very good after some time, the manager of the note could continuously, let's say, market the product and raise additional capital, via which he would go afterwards and subscribe. Actually, we will come to that in a second. So in this slide now, we go a layer further down to see for each product how it would work. Basically, so here we have a tracker certificate on a single fund. That's a very simple product. Tracker certificate means nothing else than a Delta One product, right? So the product itself, its price would reflect one-to-one the performance of the fund. So on the right side of the slide, we have the investors virtually. So an investor through his bank will be able to make a subscription. This part is always the same. So, and because the only way for an investor to subscribe to a note is via his bank, right? He cannot just wire money by himself. It means that actually, unlike the funds, we don't need to perform AML KYC on the investors, right? Because this would be something that by definition, their custodian banks would do. So that takes away already a very large amount of effort and time required for somebody that would usually have to do in order to invest in a fund. In the middle, we have the tracker certificate. So that would virtually correspond to a sell of a SPV. The tracker certificate will have its own ISIN. So the custodian bank of the investor will settle DVP, delivery versus payment, with the bank which is appointed on behalf of the certificate. And this way, the manager, which will manage, of course, the certificate and the liquidity, will be able to pool investor capital for the purposes of investing in this fund. So it is entirely up to the manager what would be the minimum ticket, the fees that you would like to have on the tracker and so on. Typically on our site, the minimum subscription amount is very, very small. It's just 10 units of the note, which usually corresponds to $10,000, euro, and so on. Of course, this can be higher, but exactly because the manager does not need to actually onboard the investors, right? The only thing he will need to do in order to accept the order is to click on the specific button on our platform. So he might as well leave it at 10K. Now, once the note is funded, normally at issue date or after issue date, then the manager will instruct basically so that the subscription is done to the fund. So he has identified, of course, a fund. Here is just an example. Of course, we have an AIFM or a SICAV, right? It could be any kind of fund. And that will be through the normal process as a fund subscription form. Something that question that I get often from clients that are used to funds is, okay, in this case, who is the actual investor in the fund? And the answer is that it will be the SPV itself, right? The SPV, being a standalone legal entity, will be the investor into the fund. And then basically, of course, there is actually no look-through into the end investors because, as we mentioned before, they're represented by their banks, right? So this way, the manager of the note, so let's say he starts with 5, 10, etc. million. The note goes live, the subscription is done, so the note itself starts having a performance of the fund, and then the manager can define how he would like to handle things like the liquidity, for example, right? So usually for increases in the size, it's quite simple. The manager can choose, if he tops up basically on the fund every time he has an extra 200K or 500 or a million or 5 or 10. It's at his discretion, whereas at redemption, so let's say if an investor would like to exit, then basically it's also his discretionary, and that's something we mentioned on the term sheet as well for transparency. Would he have liquidity gates? Would he have maximum amounts of drawdowns per quarter? Or in case that the fund is completely liquid, we can also have liquidity at best effort basis, which means that the manager is not obligated to get the investors out, but he would be able to do so depending on the market conditions and the liquidity in the note. The next slide is virtually the same case, but in this case, we have still one note, but this one note, one structure note, would invest in funds and not just in one, right? So it is the equivalent, let's say, of a fund of funds situation. Obviously, the actively managed certificate, in this case, the AMC, that will be the type of the product, is not legally a fund wrapper, right? It's still a note, a securitized note. So basically, in the exact same manner, on the right side, we have the investors that receive an ISIN and through their bank subscribe. The cash is pooled into the cash account of the note. And from there, the investment manager can deploy into the different funds. Here, let's say, for example, there are 3 funds that you would like to have in the basket. It's an active managed product, right? So that means that you can start with one fund and go up to 2, 5, 10, etc. Or throughout the lifetime of the product, he could redeem one fund and purchase another one. So it is at his full discretion. And actually, if you think about it, for an investor, it's a fantastic tool, right? Because let's say, and we have such cases, somebody will launch a nice product on 3, 5, 7, etc. hedge funds. It would be virtually impossible for an investor for a small amount and for funds that have usually quite some high minimums to get this kind of exposure all at once, right? So here it's very simple. The investor would just contact his bank and make a subscription. So it actually adds great value for the investors in this case. Now, with regards to the end product, right? So as we mentioned before, the note itself is a 6-cleared, bureau-clear, etc. product. It has an ISIN. We would usually quote it in Bloomberg on request of our client. So there you have the usual Bloomberg screens, HP, DB, GP, DES, etc. So basically, it is a very institutional setup. Also for the family offices or asset managers, usually it's a very good tool because they would have portfolio reporting queries and so on that are usually connected to Bloomberg. So the pricing of the node would just feed through the existing infrastructure, right? So a few bullet points to summarize a little bit the setup. So as we mentioned before, we have a very low minimum investment size. Normally, the number of investors is not limited for these nodes. The underlyings can be across asset classes. As mentioned, we can combine any kind of liquid with illiquid or semi-illiquid nodes. The standard, let's say, offering, as we understand, these are sophisticated investment products, right? So normally these will be addressed to institutional and professional investors around the world. We do have the possibility to add as an overlay retail distribution in Switzerland, right? So that will be, there we would obviously have to do the prospectus. It has to be collateralized. We need to have final terms. We would create a public available website that the retail investors could have access to all the documentation and the price as the regulator dictates. So the whole offering will be basically offered by us. 3x6, as mentioned, we work with the Vienna Börse, the Vienna Stock Exchange, so we could have the notes listed there, again, on request of our clients. And finally, the liquidity is a very important point. So as I mentioned before, normally the manager will dictate and will decide in the beginning what the liquidity will be on the note. We can imagine a situation where there are several investors booked into a note. The note, especially if there are multiple funds as underlyings, would normally follow the worst of liquidity. So let's say if you have 5 funds, 3 of them have monthly liquidity and 2 of them have quarterly. Normally, the note would follow at least quarterly or even larger tenor. And then even in between, what we see quite often is that a client, an investor, would like to exit for whatever personal reasons or a balance. So in this case, normally, when you invest directly in the fund, that's not possible if the fund doesn't provide liquidity at that moment. But here we have nodes as an overlay in between, right? Which means that the manager of the node could actually have another market participant, so another investor taking over this exposure and thus getting the first guy out. So it's a much simpler, a much more custom, let's say, tailor-made way for somebody to manage structured nodes and ultimately give investors exposure to funds. Here we have just 4 very simple examples which are derived from real-life cases that we have done. So we have done, let's say, from the 1.2 thousand structured nodes that we have launched, we have probably 40% private markets, and some of them have multiple underlying. So that gives you a little bit of an idea of how many different cases we have come across. I will just browse very quickly through them. The first one is an AMC on a hedge funds portfolio, right? Something which I haven't mentioned is the fact that any one of these nodes, even if it's a, let's say, Delta 1 tracker or a basically participation payoff, also has the possibility, if the manager wants, to distribute interest or coupon, as we say, to the investors, right? And that's also a very interesting component to say, okay, the investor will not have to redeem, let's say, the note in order to participate in the performance, but the manager could also distribute some proportionally through the clearing agents, of course. And this could be, normally actually for fund, it will be discretionary, meaning that the actual amount or even the timing will not be predetermined, but there are multiple variations. So the first one is an AMC on hedge funds. Second one would be a tracker on a private debt fund. So the fund itself invests in private debt opportunities, and basically the investors can get exposure into the fund via tracker certificate. The third one, so bottom left, that will be a tracker on private equity fund. Similar process. The only difference is that the fund itself will be invested in private equity of different companies. And then the last one is as well an AMC, an actively managed certificate on private equity funds, right? I would say at the moment we see probably more like a 50-50, or maybe there are a few more products which are focused on a specific fund, right? Because it just facilitates access, investor access. But we see also more and more situations where people construct portfolios that have multiple components, private and liquid, which we actually call hybrid. Now, the last point, which is probably the most important one, is that the entire setup is operated via our platform, right? So Ten2 has a homegrown platform, which was recently upgraded to the version that you kind of get a glimpse now, and hard to believe it looks absolutely great. So the platform is available to our clients anytime, anywhere. You can go from your phone to the tablet and so on. From the very first step that somebody would launch a product, this will be done via the platform, requesting all the relevant information, uploading the different documents required. Then throughout the lifetime of the product, you have all the workflows in the platform. So potential cash transfers, fund subscription, fee payments. Normally, the notes have administration, management, and performance fee, which is paid quarterly. And the most important thing is that the orders themselves, so any order, an increase or decrease, will come from an investor's bank, will actually show up in the platform, and the manager will have to click the accept button before the order comes through. So the manager of a node will be in complete control of the inflows and outflows of every strategy. Also, when there is an incoming order, he has the possibility via a comment field to have a potential distribution fee, depending on his commercial arrangement with the distributor and so on. And all that is basically available anytime, anywhere via the platform. Having said that, I would like to open the floor to questions. I think we are right on time. Okay, yeah, 2:59 Swiss time. So yes, looking forward to have any questions from the audience. So the first question is, in case there is an AMC that has is invested in a fund or P and VC funds, etc., can we use basically subsequent subscriptions to increase the size and match potential needs, right, for financing? Well, answer is yes, right? So basically, you can think of it as the AMC is virtually, in the beginning at least, an empty basket, right, that is funded with cash. Then, depending on the schedule of the subsequent investments, also to, let's say, what is the proportional size of additional investments versus the initial one, it's up to the manager to decide, does he want to call most of the capital upfront and have it invested in money markets or so, or does he want to have basically the size increased at the later stage and thus facilitate the upcoming capital calls and so on. With regards to the structure itself, we have a few questions. So basically, all our SPVs, so at the moment we have something like 290 of those SPVs incorporated in Guernsey. So the SPVs themselves are basically administered, if I can say it's the most relevant word, by a company, independent company based in Guernsey, which are the corporate directors, and this company is regulated in Guernsey by the GFSC. So they are embedded in our platform actually with their own special logins, so that they can perform all the control and other operational functions seamlessly, let's say, for our clients, right? Next question is there a fixed maturity or can the life of the AMC be unlimited? Actually, indeed, both apply. Normally, an AMC is an open-end, right, structure, so it has no predetermined termination date. It depends obviously a bit on the business of the investment, right? Basically, our client, the manager of the AMC, can decide. I would normally say that since it's always more flexible to say I have an AMC which is open-end, and then it has an early redemption possibility, right? Which anyway has no additional cost for the client. So that you launch the AMC now, you proceed with the investment, and then whenever this is not required anymore, it can just be terminated, right? But both actually are possible. Another question, which is also very interesting. So for an SPV on art paintings, for example, how is the ownership of the works materialized? So indeed, lately we did have some very interesting cases of art, physical art. So art or any kind of real hard asset is treated exactly the same. You can facilitate the investment either via equity or debt, right? So let's put it this way: the art is owned by a company, and then the SPV can invest in this company either by investing in equity, and there you can also have different share classes and so on for different reasons, or debt or a participation loan. There, as mentioned before, the UBO, let's put it this way, of the investment would always be the SPV itself, since it's a standalone legal entity. Whether we have had cases with UK real estate debt. So yes, indeed, we have had, I mean, out of the top of my head, probably I cannot remember one right now, but we have had literally hundreds of products in private markets, including the UK, right? Are we planning to have a platform in the EU? So basically, the products themselves, being structured notes, they are purchasable also within the EU, of course, in line with the local rules and regulations of each of the countries, because as I guess our audience knows, even within the EU, not all the countries have exactly the same requirements for different investors to buy. Obviously, that would have to be with respect to the MiFID rules, and the investor will need to classify it not as retail, right? That is probably the most important point. But other than that, it is possible technically, legally, and economically for a bank to subscribe on the notes. Can a company raise money through X number of years note 8% through an AMC? Yes, exactly. So that is a very typical case, right? So there's a company who would like to raise funding or to finance an existing obligation or loan. So they're basically, we could do directly in this case and not through a fund, a note whereby this would basically the SPV itself, we proceed to give a loan agreement, via loan agreement to the end company, to the target company, and that can yield an interest to the investor, which is paid quarterly, annually, and so on. There, actually, as I mentioned before, to make the distinction, in this case, normally there would not be a fund required, but it would be directly the loan agreement into the product. And also, most likely, we will not need an AMC per se as a structured note, but we will probably be called a credit-linked note, CLN, which is the standard instrument for providing private debt financing in companies. Is an investor, so basically another question is, how could an investor purchase basically the note, right? Be it an AMC or another payoff. So the note is purchasable normally through the custodian bank of the investor. So the investor will not necessarily need to use a broker or some kind of, let's say, specialized trading equipment. He should be able to go to his bank and ask them to open the eyes and thus subscribe through that. Of course, not all jurisdictions, all banks, etc., work in the same way. But basically, I mean, we can say that in Switzerland, we have hundreds of orders coming in for our notes on a weekly basis. So it should be absolutely, very, very, very easy. Now, depending on the different country, of course, we will have to see, what is the standard modus operandi, which bank from the investor, which broker will be the one subscribing. Are they open with, do they have a relationship with the paying agent, virtually the bank that is the book runner, and so on and so on. Another question, which is very important actually. So, who does the KYC AML of the investors? Most of the time, investors onboarding is the biggest pain point for managers. Absolutely correct. So to make the distinction as well, we're all aware that when somebody would like to raise capital privately via private equity, private debt, or via fund, right? There has to be a, let's say, normal, proper AML KYC onboarding of the different investors, right? Now, the very big difference with the notes that have an ISIN is that an investor cannot, let's say, wire cash into the note or the bank account of the note. An investor can only basically instruct his bank, his custodian bank, the actual bank that he's using for his different investments and so on, to place an order, either a subscription order in primary market or secondary market increase into the note. By definition, that means that the bank A will have done AML KYC on the assets of the investor, right? Because it's their client, and as far as I know, there is no bank in the world that would not do AML KYC on the assets of the investor, source of wealth, etc. And B, the bank will ask for the term sheet of the product, right? Which is the legally binding document. So the term sheet, which is 6-7 pages normally, will have very clear instructions and description of the note, the risks, what are the eligible markets, who are the eligible investors, and so on. So by definition, before the bank actually makes a subscription, needs to have basically checked all the boxes that this investor is eligible for the specific investment, right? And that is exactly the reason why the manager of the product itself is not responsible for that. In fact, in our platform, when you have a note, you will not actually see the end investors' names as well, right? So you would see, for example, let's say UBS or Pictet or whichever bank it is makes a subscription for 500K or 1 million, and they're actually you will not even know legally whether this is one investor, this is five, where they reside, and so on and so on. This is the bank's responsibility to make sure that they are eligible investors for this note. We're having quite a few additional questions, so I will try to cover as many as possible. In case of a physical underlying, how is the storage and insurance organized, and so on. So indeed, in case we have, once again, this is for physical underlying, so not through funds, right? They're normally as, let's say, part of our setup and our due diligence process. We will need to make sure that we have in advance, insurance agreements, storage agreements, and so on with reputable providers, so that we ensure for the investor that when he purchases a note and that gives him participation to a certain investment, there is a solid setup in the background, and basically all the books are ticked, right? This is a pretty standard process actually. So every time we have a new product launch for the platform, then basically we have a predetermined list of due diligence documents that we will need to go through, and then basically this will be applicable to the specific case. Of course, as we have seen more complicated transactions, actually more and more, I would say, there is always a possibility that there will be a specific country's notary that will need to provide some documentation, or there will be translations and so on. But that is also part of the service we provide. So our teams will analyze the case and provide the best possible solution, right? And also that is something that affects the timing as well, of course, which is another very important part. So the timing depends a lot on the actual underlying investment and at which point, let's say, we would be able to receive the full DD pack requested, right? So I would say that on a, let's say, vanilla case, so we have a fund and there is a up and running SPV and is able to just create new notes. We will probably look at something like 4 to 6 weeks, right? We are actually investing a lot of time and effort to reduce this amount with technology, with new processes, with experts and so on. But at the time, it will be something like 4 to 6 weeks. Of course, depending on the case, it could take longer, right? If some documents are missing or there is any kind of complexity, but this is our expectation. On the fees that are basically possible to be added on the note. So maybe as a quick recap, once again, normally such a note, being an asset management product, is having recurring fees and upfront fees. And this is, I'm talking about the fees that the manager of the product can receive, right? So let's say somebody would launch an AMC on liquid assets or on funds and so on. There normally would see a management fee, there would be a performance fee. Both normally are paid quarterly to the manager of the product. So at the end of every quarter, so the fees accrue daily based on the NAV and the performance, and then at the end of the quarter, the manager is able to receive the fees. And then as per the usual structured products manner, it's also possible to have upfront fees. So usually you have a distribution fee, which is added to the trade price, or there can be upfront fees, which are actually deducted from the trade price being still at face value, right? And there we can also have this as absolute or percentage, and this can also be amortized over a couple of years. So let's say if there are costs in the process, for research or to set up the structure, then these can basically be charged and amortized with the first note. I will just scan through the remaining questions. And by the way, I will follow up with all the participants with an email as well with the contact info. So I will be more than happy to continue this discussion. So the last point is, what is the minimum size for an AMC? So we as Gen2, we will not impose a minimum size. This is entirely at the discretion of the manager. We have had several cases with AMCs, which basically started from zero, and then they just build up over time. Of course, the economics need to make sense, right? But depending on the case, I would say even for sub 1 million products as a starting point, the pricing would actually make perfect sense, right? So the fees would not drag the NAV and the performance of the node. So having said that, I would like to once again extend a very warm thank you to all the people that participated and actually stayed until the end of the session. We will follow up with the recording and the presentation, and I will be very, very happy to continue the discussion with all the participants. Thank you very much. Have a fantastic afternoon. Ciao, ciao.